What up? Alright. Little sleepy day going on. I have my chart on a different screen. This is disorienting. Not any better. How am I gonna do this? I'm not sure. Actually, I got an idea. Boom! Alright. Now I just gotta move this up. There we are, back to the old school. Or I have a better idea. God, should have thought of this first. Let's do this. Switch them. The switch. Nice. That looks good. Alright, I put clothes on. It's gonna be a pantsless day, but for you guys, anything. What's up, the Thermo Queen? What's up, man? Thanks for subscribing, good to have you. Speaking of which, great to have everybody here. You know, this is something that unfortunately is really boring, but it's important. And it's how those things tend to be, right? So, happy to have you guys here with me. It would be a lot more boring without you. And, I don't know. We'll see what happens. People are saying that they already voted. Maybe that's true. As far as I know, they haven't. Because why would they still be then debating it? But I looked up some news sites. I don't see kind of a conclusion. Like, investing.com doesn't have a big article saying they did or didn't pass crypto provisions, etc. So I'm leaning towards they haven't voted yet. We watch a lot of the Fed announcements here live, and what you find is there's just a lot of downtime in between everything. Kind of maybe typical politicians. They talk for 5 minutes, they need 30 minutes of downtime. I don't know. Let's take a peek here. Actually, we're going to start real small. We're going to start on the 15. So, if you guys saw me doodling earlier, we're seeing a lot of similar price structures. We're seeing ascending highs, and we're seeing higher lows, but it is a broadening wedge. Happening today. All right, let me get into it. I'm like, not in the zone. What we're seeing here today, saw a little whiplashing, saw a higher high, followed by a lower low. So what we can pretty much take away from this is that we're going to see something along these lines. I think Ethereum's already doing this. Well, diamond. People consider these a reversal pattern. I don't see them in crypto reversing very often. They actually tend to lead to continuation, at least in my observation. So from our high to our low, we're back to the 618, 43,784. You can see price has interacted with it twice already. Looking to break that, move up to 44.1, or the full retracement, 44,600. If we get it, let's see where Fibonacci would suggest we'd look next. 45.9, all right. 46.8, it doesn't really line up with much. That's okay. Basically, we already know. We don't need Fibonacci right now. It's a mark of a great trader. Knowing when to use tools, not just how to use them. When to use them. So, here's where we've been looking. Since May. Same thing. Nothing changed. The only thing that changed is people now don't think it's crazy to be calling for these levels. Let's take a peek. Weekly doesn't have too much resistance. We see 43.8 from back in February. And then we have in April 45.2. No, that's higher. 49.1, right? Yeah, 49.1. That's right above. I wonder, as a throwback to Mr. Casper, Mr. Jason Casper, I wonder if his 165, or if his 6.65. I wonder if that's really close to there. So let me see here. What if I do it this way? Will this work? Ooh, it's gonna work. Oh, would you? Would you? Look at that. Woo. All right, Mr. Casper. Maybe you're onto something here. 618 retrace. 0.65 retrace. Right there at 49. We were looking for 48. 49's close enough. All those numbers are really similar. The only factors that have really changed since we started looking is that 20 weekly. Here we are at the gates. The gates. Wasn't worried at 30. Wasn't threatening. Now we are in potentially threatening price territory. We can see this week, aka today, we've traded above the 20. Now we're back below. Not ideal. Not what we want to see, really. Not at all, actually. But all hope is not lost, and we are going to, right now, show you what you should be looking for. Alright. So here we are. Pull this up. There it is. Bam. On our daily calculation, sitting a little higher than weekly, we've also traded above and are now trading below. So if we look at both the daily and the weekly, I think we're looking just about 44. 44. So that's what's changed. When we originally fell, you can see that 20 weekly hung out, just chilled in that box, right near the 618, the 65, retracement from 65 down to 30. Everything was pointing there. I really never doubted it. Here is where I don't have the same confidence. I don't know what's going to happen here. All of this, I can't say I knew. That's just not honest. No one knows anything, or they're stupid enough to think they do. But I had full confidence we were going to the 20 weekly. It's happened every single time. Every single time we've entered a bear market, we have broken the 20, back tested the 20, rejected, gone to lower lows. So basically what we're looking for here, well, step one, don't break the low. What's up, Rick Flair 19? Over on Twitch. Subscribe. Thank you. Good to have you. Step one, don't break 28.8. I think probably no one, no matter how novice you are, probably no one needed to hear that, right? That's okay. We're going to get a little better. So watch this trend line right here. See this. This is important. We have a very solid pattern here. Actually, I drew that wrong already. Make it easier. There we go. Very important pattern here. One that we've been watching on this channel. You guys know, I'm not a huge fan of it, but a spade's a spade. This is Wyckoff accumulation. Doesn't guarantee that it will play out or continue. This could fail. All patterns can fail. They're not invincible. There we are. This one's nice and easy. No. Open image and new tab. There we go. So, here we go. I'll have to go like this. The screen's all off. It's throwing me off. Let's go that. There we are. We can see. We are now after low, low, low. The wicks on our candles here would kind of actually describe it the other way, but if we look at the body candle closes, it fits perfectly. This is something we've looked at for a while. This is not just something we're bringing up now. In previous streams, we have this weak bounce, rejection, and now we have what could be consolidation at resistance. Let's go back to the chart. Where'd you go? Oh man, I did not plan this. Too many tabs up. As always, there we go. So this fits so well. So well. Actually, you know what I'll do? Because they're being really boring right now. Let's pull this up. I'll just throw this over here. Yeah. There we go. That'll work. So this way you guys can look at it while I do this. I think that'll make sense. So let's clean this up. I don't want don't want too much on this chart because this is going to be a concept that, while it is simple, a lot of people are going to kind of be stumped. So I want it to be as simple as we can. Let's take the wicks off. Now, this is cherry picking. I admitted it the first time I did it, but I don't care. Because it fits so well, I just don't care. So we take a look at this pattern. We already had this marked previously. This would be, I would consider this the point above AR. I can't remember the term for it. Point above AR. Essentially, this is the resistance, right? If we look over there, I guess it's in the top of the screen. That's an important point. When in relation to two other pieces, a spring right here. And then what is SOS? I totally forgot all the terms now. I did a whole episode on them. I had them memorized and I forgot them. The SOS essentially, though, is consolidating, accumulating, whatever you want to call it, at resistance. That is why this point's important. Here we are. This could play out many ways. It could play like this. That would fit very well. If this plays out, we'd expect to move to the upside. Where? Well, probably to that 48-ish level above us for the retrace. Let's put these other points out. We have double bottom here. That is a great sign for the spring. Great piece of evidence for the spring. And we have what I will consider here. Yeah, good enough. I'll take this. This can be the SC. This can be the ST, right? Doesn't really matter. What's important, though, is everyone got caught short right here. It doesn't have the typical back test of support that we do look for on the Wyckoff schematic, but screw schematics. It's not about schematics. It's about market sentiment. It's about actors, and it's about people making decisions. The whole market before July 21st, right here, when this was the chart we had. Go away, candle. Everyone was bearish, rightfully so. I mean, I wasn't, because I'm crazy. But rightfully so. The chart looked awful. There was no reason, in a technical sense, to be bullish. So the market was very much caught short. July 21st, spring. That's what makes this spring. It is a large move in the opposite direction, a reversal. But it's catching participants off guard and catching them in the wrong position. The place or the price in which we've rallied to is really, really important. Above resistance. If it was below resistance, this, even without the wicks, we wouldn't call this Wyckoff. So what would we look for here now? Like 4 hour. There we go. Well, we could say maybe we're going to see consolidation. Maybe we'll see 40,500 tested. Then we'll see lower highs, maybe higher lows. This would be ideal to see a very smooth trend. Descending highs, ascending lows would be perfect. They're still not doing anything, by the way. This fits. It fits. This pattern doesn't, like I said, it doesn't change what's happening. It doesn't have to consolidate like this, but if it does, it paints a perfect Wyckoff. You essentially have a series of lows. The last low being the spring before the takeoff. Then consolidation. Hard to argue it. Hard to argue against it. It really is. If only that mattered, though. So here's something that I actually I'm going to shout out to Crypto Jack here, because if he hadn't tweeted about something along these lines, I wouldn't have noticed it. Uno segundo. There we are. What pattern do we have here? A very strange one. Very strange one. This is how I would likely draw it. Something along these lines. Like that. What we have is a broadening wedge. We tested the top of that wedge for the third time here. Right into August. Sold off for a higher low. Now we're above the wedge. So what we're looking for that lines up with what we're talking about is a pullback to the high trend here. This creates a very bullish pattern if it holds. If it doesn't hold, we go back down. We pray that our low of August 5th holds. If it doesn't, we're kind of back to where we started, or I'll even make the argument we're worse off than we started. Oops. As we're about to go full circle here, why does that not line up right? Oh, because I'm on the 4-hour. Derp. Okay. I would argue we're worse off if we do break 37 now. We were looking for a 35. It looks like 37.3 was what we got. If we set a lower low, it doesn't doom us, but this is going to be a big signal. Our immediate validation, I guess, of this pattern being bonk is breaking back below the wedge. This one, I would say, is the least sure, the least confident. The least confident. You could dance back down underneath. Crypto loves doing that. Coming back up. But I would like to see 42.2 hold. This is where I'm going to start wondering if we really are going to break through it. One thing of note that's positive is we didn't see a huge wick today. That's something I was afraid of, is maybe we wicked up to 48 and then closed below the 20, and then that's just bear season. So losing 42.2, not the end of the world, but if we lose 37, if we lose August 5th's low, this looks really bad. You do have support below, but you are so threatened, or price is so threatened. Let's see where that is. Here, 35. Price will be so threatened around there, and there is a lot of support here potentially. But the farther down you go, the closer you get to these lows, the uglier this is going to be. We're finally here at the 20 weekly. It took 2.5 months. The 20 daily just above us. It would be very odd to me not to see that tested, no matter what. We're already so close to it. So I would say this weekend is probably the right time frame. Today is possible. I don't like saying today. This is where it gets scary. We don't know what's going to happen. I don't know if anyone knows what's going to happen. So best bet, best hope, let's stay above 42.2. Break that, then we're going to have to look lower. Pray. We're going to have to pray. I don't know if they're ever going to come back. These people, they talk for 10 minutes and then they take 3-hour breaks. But so far, we're looking good. We're in a very different position than the 20th of July. Not even a month later. Only 17 days later, we're in a very different position. Now we're above resistance. These resistances that people seem to think we're never going to break. Now we're back above them. Now we're dancing with the 20. I want to see that. I want to see us close above it. I want to see a back test. I want to see this. Yeah, I'll take that. Something like this. I don't know. I don't know if it's going to play out that way. Nobody does. I certainly don't. That's what I'd like to see. Luckily, we do have some decent signs now we didn't have before. As of yesterday's close, so after our stream. Daily money flow positive as predicted. VWAP still trending up. Money flow still trending up. Momentum still trending up. So we don't have, on the daily at least, a sign of this being done. Daily is not saying this is over yet. What's happening here? There we go. Click down to the 12. 12 also positive on, what was it? On yesterday's close as well. Interesting that the 12 and the daily both flip positive on money flow at the same time. Not a super common occurrence. Momentum still up on the 12. 6 hours where it gets a little sketchier. This looked so beautiful back here. So much strength. Then we set a lower low, and now it's lost some of that momentum. What we're really going to want to see is this not happen. We don't want this to happen. We don't want the momentum to roll back over. And if it does, and honestly VWAP is suggesting it will, if it does, we really don't want to see a lower low on momentum, and nor do we want to see a lower low on money flow. If money flow doesn't really dip, then it could be okay. That would probably catch before it flips over or rolls over. But man, I've been nervous for this price point for 2 months. Because I knew it was coming. And I knew when we got here, this would be when the real threats are in play. That said, the chart looks way better than I would have assumed for where we are. I was thinking we were going to see a really sketchy test of it. Super straight rally, though this is pretty just up, right? I was thinking maybe in like 5 candles, we were just going to go like this, and then we're going to sell back off and go down. That was a possibility in my head. But now that we're here, we're back on top of all of this range. All of these previous resistances now looking to potentially be support. We're above them. We're out from underneath their weight. And we're on top of our highest trend. A back test to that trend would be fine. Would be great. That would be strength, actually, to find a low here and test the 20 again. Then the odds, I would say, are on the upside. It's really going to come down to, does the rally get stopped out here? Which is interesting because you have one more day this weekend. I don't ever want someone to trade based on like it's a weekend. It goes up, it goes down. That's stupid. However, we have seen these weekends kind of trend in one direction. If a weekend opens to a dump, typically it dumps through the weekend, at least in the last memories, right? That might be an interesting thing to look at. When was the last weekend? Friday the 30th. Let's see what happened. Friday, Saturday. So Saturday, Sunday, there we go. Weekend dump. Reversed August 2nd. So at the 23rd? 23rd. Green. Kept going green. One more. 16th. Ooh, here's a fake out. Maybe that's why people got extra bearish. I don't know. Or no, the 17th. So 17th and 18th, same color. That's funny. They are. So that fits the pattern. Saturday and Sunday, right here. Same colors. Saturday and Sunday, red, red. Saturday and Sunday, green, green. Saturday and Sunday, green, green. This is actually pretty cool. Let's go back to the 10th. Womp. There we go. Never mind. But still, 3 out of 4 of the examples as we go back. Pretty predictable. I would bet Sunday that we see a green candle. But closing into Monday could be dangerous. 200's at 44.8. We've tested 44.6. That's close, but that's not actually to the 200. I again cannot imagine that not happening. Can't imagine that. It's like a total. Total has some good stuff for us. Let's see if total has the same pattern, actually. I don't think I've applied that trend line to total. Total, we looked at yesterday, is actually more bullish than Bitcoin, which might not be good for Bitcoin dominance. Might see that actually go down when I'd expect it to go up when we break this range. 618 sitting above us still, reaching up for it. Looks like it's currently battling with weekly resistance here. From these lows, whoa, dropping stuff. There we go. But the 20 is above the weekly, so this is interesting because we're going to get to look at 2 charts to get an answer. If we see a rejection on Bitcoin from the 20 this weekend, but we don't on total, still pretty good. Vice versa. If we see total reject, we don't see Bitcoin, still probably pretty good. If they both reject from the 20, it'll be ugly. It'll be ugly. Again, I don't think we can call it a rejection until we have some kind of low. We break some low looking left, but it's interesting. We're gonna have both charts to look at. It's unusual. So this doesn't have the same pattern. It doesn't, because this is descending. Huh. Fancy that. I kind of expected these to have the same pattern. Kind of expected it to have that high trend as well. Let's see these. Oh, that's pretty cool. Check this out. This is why you always keep your old TA. Never get rid of it. Get rid of your old TA. Look at this. This line drawn back in December. Look where we touched. That's pretty cool. I like that. Right there. Is it? Wow. It's like perfect too. Awesome. Awesome. I'm ready for this weekend to be over. I want to know. I want to know if we're going to go through the 20 or not. Oh, God. On the upside, ADA hit our target. Sweet. Ethereum also hit our target. 30,000. Or 3,000. 30,000. Not this year. Maybe. 3,000 Bitcoin did not reach where we were looking yet. It got close to 45, but I'm just going to say it didn't. Raven did it while we were live. XRP, there we go. That's a new one. Hit our target today at 79 cents. Nice. Oop, are they back? Let's switch them. They're back, maybe. Or no, just someone coughed in. Someone just coughed in the camera. Son of a bee.
Mr. President.
Yep.
The senator from Utah.
Ask unanimous consent to suspend the quorum call.
Without objection.
Mr. President, we're debating a bill that a number of us have spoken on a number of occasions. Since my last address on the Senate floor on this topic, we've received a score regarding the bill from the Congressional Budget Office. Now, remember, it's the CBO's score it's the CBO's role to put together a score on legislation we're considering. It's part of how the system works in Washington, so we can assess what will and will not add to the deficit and how it will do so if it does. It's an important part of the process. When we finally received the CBO score just about 48 hours ago, we discovered a few things. We discovered that despite the representations that we've heard by the bill's staunchest advocates to the effect that the bill would be paid for, that is, that it would not add to the debt and deficit, and that it would not add to the debt and deficit in a way that also didn't involve raising taxes. As it turned out, the CBO rejected the claim that this bill was paid for. In fact, the CBO concluded that 256 of the $550 billion in claimed pay-fors didn't pay. That they're not pay-fors. And thus that they will considerably, I mean, we're talking here about over $250 billion that would go right on to the debt and deficit. They also concluded that in the long run, over the next 10 years, we'll be looking at an additional $340 billion in cost to the federal government, a cost that by some estimates could reach as high as $400 billion because of the spillover effect that this bill is likely to have on future spending, contracting authority and otherwise. So this bill is not paid for. The pay-fors suggested by the bill's proponents don't get the job done. In fact, more than half of them simply don't get there. We do, however, see that there are some of the pay-fors that create significant policy concerns. So one of the pay-fors that isn't fake is an extension of the so-called G fees. G fees being imposed by entities like Fannie Mae that will inevitably increase the cost that home buyers will face when they go to buy a home. Now, why does that matter here? Well, we've seen a startling uptick in inflation across the board, everything from gas to groceries, everything from health care to housing. We see that increasing stunningly in a way that a lot of people are pointing out correctly, that first-time home buyers are now finding it very difficult to get into a home. This is something that's going to end up affecting all poor and middle-class Americans at a time when they can little afford it. And yet we're increasing these fees that are, in effect, a backdoor invisible tax on a lot of those who are at least in a position to pay it. Some of the other non-fake pay-fors that actually do bring something in include an increase in the fees paid by manufacturers and distributors of certain chemicals. The issue there is that this fee, well, labeled as not a tax, because technically speaking it's not a tax, will end up increasing the price of basically every consumer good purchased by the American people. The way these things end up working is that, to the tune of about $15 billion or so, Americans will find that pretty much everything they buy, from apparel to electronics, will get a little more expensive. They may not see it. In fact, the overwhelming majority of them won't even know to attribute it to this particular piece of legislation. But it will have that effect. It will make all Americans a little poorer. It'll make all Americans face a very stark reality in which their already strapped dollars that they earn will go just a little bit less far. We have to remember that from one year to the next, we don't see dramatic fluctuations in the quantity of goods that the American people have access to, that they may buy. In other words, the U.S. economy is capable of producing a relatively foreseeable, predictable, somewhat finite supply of goods in a particular year. When that doesn't change dramatically from one year to the next, as it almost never does, but you dramatically increase the money supply in the U.S. economy, then what you see is that everything gets a little bit more expensive. This ends up hurting, in particular, America's poor and middle class. It ends up hurting, in particular, those Americans, including most Americans, who in one way or another live paycheck to paycheck, who in one way or another depend on the income that they have, and the income that they have is relatively fixed. So as a result of that, they don't get as far. Now, you've got some Americans, including the wealthiest and well-connected in our society, who may well figure out ways to get wealthy off of this bill. One way or another, they can play things to their advantage, and they may make a lot of money off of it. You've got another category of very wealthy Americans, maybe, people in the top 1 or 2% of income earners, who might notice that the things they buy are getting more expensive, but it might not affect them all that much. But then you've got everyone else, and I mean the vast, overwhelming majority of all Americans, who, in one way or another, plan out each year knowing that they've got a relatively finite amount of money to spend. And that money goes less far when we just print money to the tune of trillions and trillions of dollars. Remember, the federal government in recent years has been spending about $4 trillion a year. Tragically, even at the top of our economic cycle, with record low unemployment and with record high growth, we were still spending $1 trillion a year more than we were bringing in. Bringing in about 3, spending about 4. This was inexcusable then. It would be inexcusable now, except that we're making it much, much worse. Last year, we took in about $3 trillion, and we spent $3.6 trillion. Borrowing and then printing close to $4 trillion additional dollars. What does this do? Well, it makes all Americans just a little bit poorer, especially those living on a relatively fixed income. And so this is troubling when we do that. We ought to be concerned when we do that. Inflation numbers that are coming out all the time, including some that I've heard about the first time today, indicate that everything's getting more expensive. And what are we doing? Well, we're on track to spend another $1.2 trillion. including $550 billion of new spending, which the bill's proponents claim is paid for when most of it isn't paid for. And that portion of it that is paid for is, in one way or another, often paid for in a way that will inure to the detriment of poor middle-class Americans. This is concerning. It's also concerning that one of the other pay-for provisions, the one focused on cryptocurrency, focuses on an industry that's rapidly developing within the United States.
Here we go,
It
pay
depends
attention.
on a lot of innovation happening in the United States. One of these pay-for provisions seeks to bring in more revenue to the federal government, or at least to promise more revenue to the federal government, with the promise of requiring those who buy and sell cryptocurrency to treat it the same way as they would the exchange of securities. Mr. President, this is very different than securities. These aren't just stocks. It's something very different. It's a medium of exchange that, if adopted more widely, could facilitate a lot of economic activity and a lot of innovation within the United States of America. If, in fact, we pass this bill, mark my words, it's going to have a chilling effect on innovation within this sector. And what you'll see is the flight of innovation and investment related to innovation to offshore locations around the globe. Places outside the United States may well be the ones to reap the benefit associated with the loss here in the United States if we adopt an unproven, untested, unknown strategy for dealing with something, trying to adopt many decades-old regulatory policies to a completely new form of exchange, one that, by the way, values very highly the privacy of those who exchange in it. And so if what you're going to do is take away that value by requiring that all of it be registered and publicly disclosed, and by giving the federal government the ability to peer into it, you're going to stifle innovation. You're going to make a lot of people upset, and you're going to make Americans poorer. At the heart of a lot of this is a concern that the federal government, as it takes more and more money, as it prints more and more money, as it requires Americans to work weeks or months out of every year just to pay their federal taxes, only to be told that it's not nearly enough and hasn't been enough for many decades, because we're nearly $30 trillion in debt. It's still not enough, because we're still going to borrow and print more. It's insulting to them, and it's especially insulting to them when you tell them that in connection with the same legislation that also includes other intrusions into their privacy. For example, there's a pilot program called for in this legislation that would be created by this legislation that would be designed specifically to monitor how many miles someone drives in a year. Now, this has long been a fantasy of a number of people who would like to see the federal government tracking miles driven by every motorist in America. Now, Mr. President, we all know that there's almost no way to achieve this that wouldn't excessively interfere with the privacy rights of every man, woman, and child in America. Look, the American people are fine with a government that makes sure that we're safe from foreign aggressors, that regulates interstate and foreign commerce, that coins money and regulates the value thereof, that adopts a uniform set of bankruptcy laws, immigration laws, protects trademarks, copyrights, and patents. What they do not want is a nanny. What they do not want is a snooping device added to every car that will track them, that will track where they and their families are going. It's none of their darn business. Keep the federal government out of this. Look, whether you want more government spending or not, chances are, if you're listening to this, you probably are concerned, regardless of what political hat you wear, regardless of who you voted for in recent presidential or congressional elections. You probably don't want the federal government in your car, monitoring your every move, going where you're going. We know that when governments do that, when they start to assume that everything is government's business, bad things happen. It ends in tears and worse. That's none of the federal government's darn business. We don't want the federal government even developing technology to start snooping on every person's every move. Which brings me to yet another intrusion on personal privacy and liberty in this legislation, Section 24220. Calls for the development and within just a few years, formalization and finalization of regulations that would require passenger vehicles manufactured and sold within the United States to have a device that would passively measure the blood alcohol content of the driver and do so in a way that would inhibit or at least impair the ability of the vehicle to operate if the vehicle, in its infinite wisdom, was able to ascertain that the blood alcohol content of the driver was over 0.8. Now, look, we're stopping drunk driving. It's terrible. It results in countless lives lost. But, Mr. President, we can all see a lot of things that can go wrong with that. Setting aside for a minute the constitutional implications of the intrusiveness of putting technology in every passenger vehicle that requires at the outset, without any finding that anyone has done anything wrong, that requires you to take a test mandated by the federal government every time you want to do something as simple as turn on your car. Then let's consider what happens when, with such a technology, which to my knowledge doesn't yet exist, with such a technology, assuming it's able to come into existence because of these burdensome regulations in a few years, that technology, if they're able to develop it, is going to be costly. Who does that hurt? Well, you guessed it, poor and middle-class America, who will all of a sudden find that every passenger vehicle will become a lot more expensive. It's just the way it works. When we mandate the creation of new federal regulations, and those federal regulations apply to any new automobile sold in the United States, the price of new automobiles goes up. And in the case of a particularly novel, particularly sophisticated technology like this one, I suspect it'll go up a lot. This may not be troubling to the millionaires and billionaires out there who don't feel the pinch of that, but to everyone else, the 99% of all Americans, more than that, I suppose, this hurts. Moreover, what happens when that technology malfunctions? Not if, but when. Look, we've all had cars that will malfunction for one reason or another. And oftentimes it's basic security devices, something as simple as that annoying beeper that goes off until you put your seatbelt on. Sometimes, some people will put their seatbelt on and it still pings. That's a terribly annoying nuisance when that happens. The consequences are much more deeply felt. They're much more severe if someone gets in the car, whether it's to go to work, to come home from work, to take a loved one to the doctor or the hospital, and it doesn't work. Look, glitches happen. And if you're talking about adding an override to a vehicle, maybe that override to the vehicle mistakenly thinks that it smells alcohol. Maybe it doesn't like the aftershave or cologne you're wearing on that particular day. Maybe the whole thing stops working and your car stops working with it. This isn't one of those things where you can just open up the hood and find the presence of an on-off switch, as Jerry Seinfeld might have put it many years ago. No, this is much more sophisticated technology that the average, hardworking American isn't going to be able to fix quickly. They won't even be able to see it. There again, they're going to face more costs as they take their vehicle into the shop to have it evaluated by a certified technician capable of dealing with that brand new, very sophisticated, very expensive technology. So with each of these things, Mr. President, we see something of a common theme. The federal government, which already plays too prominent a role in too many people's lives, which is already taxing us too much, spying on us too much, and considering everything under the sun its business. We're making even more things its business, from cryptocurrency to where and how far you drive your car to whether you can operate your car at all. we're doing all this so that we can spend even more federal money on even more federal infrastructure projects, which are even more expensive by virtue of the fact that we're dealing with federal dollars. For the simple reason that compliance with all the federal regulations that accompany the expenditure of federal infrastructure dollars costs a lot of money. In many states like mine, it can cost 20, 30%, sometimes even more, on top of what it would cost if these were just state revenues that they were spending. So I'd ask the question, is it worth it? I'd ask the question, do we want Big Brother knowing our every move? I'd ask the question, do we want a government that's already requiring you to work weeks or months out of every year just to pay your federal taxes? Do you want it printing even more money, making sure that the dollars that you spend, which are finite, limited, and sacred, will go